Three quality stocks to buy near their 52-week low. This is a video that I do every single Saturday where I go through a screener, I look for some undervalued stocks trading near their 52-week lows. I talk about them and I give you my opinion if I believe they're presenting some amazing setups or not. And many of you guys have been enjoying it, so I'm gonna be doing it every single Saturday. And I hope you enjoy it as always. The first one is Vici Properties. The stock is down about 13% over the last 6 months. Absolutely crazy. Vici, you could say, is a wide moat company because they own some iconic properties on the Las Vegas Strip, such as the Caesars Palace, Park MGM, MGM Grand, New York, Excalibur, Luxor, and many different properties. Those properties, they cannot be rebuilt, they cannot be replicated, and they're gonna be there forever. So this is a pretty wide moat, I would say, and it's some pretty amazing assets that Vici actually owns. Now, the best part about owning Vici is the business model of having long-term lease terms. For example, Caesar's lease term with Vici is about 30 years. With MGM, it's about 49 years. I don't know any REIT that has a 49 years of a weighted average lease term. The combined weighted average lease term for Vici is about 40 years. So they have them locked in for 40 years. I mean, it's really amazing. Now, the stock has been going down for many different reasons. The first reason is slower traffic on the Las Vegas Strip. It says Las Vegas has seen 2 million less visitors so far in 2025 compared to 2024. And Caesars Entertainment has reported 90,000 emptied room. Absolutely crazy. And it's not just in Las Vegas, it's even the regional casinos. So much that a lot of analysts are predicting that VC will end up doing rent reductions on a lot of the Caesars regional casinos. And it says the Caesar regional casinos, of which VC owns the real estate, generates $750 million in annual cash flow, but the yearly rent is $730 million. So the ratio is very small, and they're ultimately going to have to cut the rent for a lot of the regional casinos. So there's a lot of different things going on. I think on the Las Vegas Strip, it's a mix of what's happening in the politics, of course. It's also a mix of the high fees that a lot of people are complaining about in Las Vegas. You get charged a resource fee and all kind of fees. Even Steve Wynn himself, I saw him on Instagram, and he was complaining about the fees that are happening in Las Vegas and how people don't have the freedom to spend their own money, and the house doesn't always win, and a lot of people are not going there anymore. But the second reason that's also affecting the regionals is a lot of people don't want to go to casinos anymore. If you can gamble on Robinhood or gamble on the prediction markets, which I believe is the next big thing, or if you could even gamble online with online casinos and online e-gaming and e-casinos, why would you go to Las Vegas just to gamble? So a lot of the newer generation isn't really into playing physical games at casinos. They prefer to do it online, and a lot of people gamble through the stock market and altcoins and meme coins. So that's the kind of place we're in right now, and it's really affecting VC. And this is a long-term risk, but I believe in the short term, and at least for the next 10 to 15 years, those properties are not going anywhere. Las Vegas has been diversifying. The Formula One is over there. They have many more sports events and entertainments that are happening in Las Vegas. So I believe it's turning more into an overall entertainment city, not just a casino place. And if those people want to watch those events, they will likely have to sleep at one of those hotels in the casino. They have to shop there, they have to eat there, and they might gamble a little bit. So those kind of properties are not going anywhere, and that really reinforces the VC thesis. Now, if we look at Caesar's annual report, they said that the VC and GLPI, which is another REIT, they require an annual payment of 1.3 billion in terms of rent. Now, if we look at the cash flow of Caesars after paying the rent, Caesars this year had 662 million left in free cash flow, and is expected to expand their free cash flow 973 and about $1 billion in 2027. So far, so good in terms of the coverage of the leases from the free cash flow of Caesars. Caesars can still pay those leases, and so far they're holding up, but I'm not sure for how long that's going to continue. But so far, everything is fine, and I believe the sell-off looks a little bit overblown. Now, if we look at where VC is trading at, it's trading at 11 times price to adjusted funds from operations per share, which is a metric we use for REITs. But 11 times is heavily discounted. The stock used to trade at an average of 13, 14, 15 times. Now trading at 11 and a half times. I never imagined I'd see it back at 11 times, but this is what happens. So if you're buying VC today, you're betting also on a multiple reversion back to the average from 11 to 14, which could be powerful. You're also getting a dividend. The dividend right now is about 6.4%, which is very, very high, and it's very sustainable, in my opinion. And you're also getting some AFFO per share growth of about 4% in 2025 and 3.5% in 2026. So if I had to sum up an annual return, I would take in 3.5% in AFFO per share growth. I would add it to the dividend yield of about 6.5%. This is about a 10% annual return for just holding VC. But then you also have the potential of a multiple expansion with the company from 11 times to about 14, 15 times, which would get you more than a 15, 16% annual return. So I don't believe VC is offering life-changing gains by any means. I think it's an undervalued income-generating machine, like an income cash cow, I would say. And those properties are not going anywhere. The dividend is sustainable, and you can get paid 10, 11% while you wait for the sentiment to turn, which is why I like VC very, very much. The second one, which I'm not going to spend a lot of time on, is Shift4 Payments, an analyzed Shift4. And this is a stock that Michael Burry has been buying. And a lot of smart people that I know have been buying Shift4 Payments. And for me personally, it's looking very, very interesting. It's a payment processor, and a lot of them have been suffering this year, but mainly Shift4 Payments. They are number 2 behind Toast in the United States as a payment processor, number 1 in hospitality in the United States, number 1 in luxury retail after the recent acquisitions, and number 1 in sports and entertainment, which they're going to have a massive tailwind from the World Cup next year in 2026 is going to be coming up in the United States. And they have a wide range of those stadiums that use Shift4 as their payment processor, and that's really going to be amazing. Now, looking at the last quarter, it's nothing like the chart. If you look at the chart, you believe the company is dying, but it's nowhere close to dying, in my opinion. Q3 volume was up 26% year on year, gross profit 62% year on year, gross revenue less network fees 61% year on year, and everything has been improving in general. Yes, the acquisition was there, but even without the acquisition, I believe they grew 18 or 19% organically in revenues. That's pretty amazing, guys, for Shift4. And relative to where the valuation is trading at. Now, they did have some debt after the recent acquisition, but the debt is not going to be due in a major way before pretty much after 2027, where they have about $3.4 billion stretched all the way to 2032. So the debt, I don't believe it's a problem in the short term. Now, looking at the valuation, it's trading at 10 times earnings. 10 times earnings for Shift4, and it's growing so rapidly. It has grown about 72% in earnings per share this year. It's expected to grow 26% in 2026 and 20% in 2027. And it's trading at 10 times earnings. It's looking really undervalued. And there's many reasons why it's trading this way. And one of it was that the stock was a little bit expensive, of course. It was kind of priced to, you could say, perfection, and it has corrected itself. Another reason for that was the weaker economy. And if it persists, that's going to also be bad for the company and for the stock in general. Another reason that Michael Burry has talked about was tax loss harvesting. So a lot of hedge fund managers and people would sell their losers at the end of the year, which would create an opportunity in Shift4 and a lot of those stocks. And they tend to go lower before they ultimately start to reverse higher after January, whenever tax loss selling is over. But this is the one that I did a deeper dive on, but I still like the stock and I still believe it looks undervalued to me. The last one is Home Depot, which I actually shorted Home Depot back in 2022. I'm not a big fan of the company in general, especially as everything is transitioning online for the next 5 to 10 years. I think it's going to be disrupted ultimately and fast delivery. But Home Depot is down 11% over the last year. It has really pretty much done nothing. Over the last 5 years, it has barely up 29%. So it has not been, you could say, doing its best. The company has done decently well in 2025, but the 2026 outlook is terrible. They're only expecting -1 to +1% in terms of market growth, comp sales 0% to 2%. So it's really, really bad. And this is mainly because of higher mortgage rates, which is affecting the housing market. Now, even if the housing market recovers, even if it's like the best case scenario, Home Depot is giving you a market recovery rate. And the market recovery case for Home Depot is 5 to 6% sales growth and mid to high single digits in earnings per share. So this is not a high growth business by any means. So the best case scenario, they're telling you it's 5 to 7 or 8% in earnings per share growth. And the company, again, has been suffering from a decline in sales growth, mainly because of the housing market and everything that's been happening. Now, how much do you believe we are paying for mid to high single digits earnings per share growth? I would say 18 times earnings, 17 times, 16 times. It's not even close to that. Home Depot is trading at 26 times forward earnings. I think that's ridiculous. I think the stock should be trading where it was back in 2023, 19 times, 18 times for such growth. I think is fair. 23 times is kind of getting priced to perfection, in my opinion, especially taking into consideration the revenue growth of Home Depot, which is best case scenario, 5 to 6% or 8% in earnings per share. Now, looking at the average, you could say revenue growth over the last few years, it has grown 4%, 6%, 7%. But the company has done a lot of buybacks. And with the buybacks, they have grown much more rapidly. They have grown double digits at certain times because of the buyback program. And even Home Depot and Lowe's, especially Lowe's, they borrow a lot of money and they buy back stock. And that's how they increase earnings per share, 8 to 10%. But if we take in their own guidance of 8% earnings per share growth, best case, and we look at the dividend, with the dividend right now is about 2.6%. 2.6% is sustainable because the free cash flow yield is about 4.2%. So this is like a 50% payout ratio. So I'm getting 2.6% in dividends, 8% in earnings per share growth. This is like a 10.5% annual return on Home Depot. But unlike Vici, I'm not seeing any room for a potential multiple expansion for Home Depot. I'm only seeing a multiple contraction from here. So I believe Home Depot is the least attractive of them. I believe Shift4 is the most attractive, and Vici also, they're very, very attractive. Not a big fan of Home Depot. But that was my opinion on those three stocks for today. It was not financial advice, so I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.